Hi everyone, my name is Adrian and welcome to the third video in my beginner's guide on passive income investing. In this video, I'll explain what the different types of dividend stocks are. So let's start with the easiest and most basic one of all. I like to call just a regular stock. So this is where you're buying shares of one company or business. When you do that, you're essentially becoming a part owner of the company. A very tiny part owner if you're only investing thousands of dollars like I am, but a part owner nonetheless. So what are the advantages of buying shares in an individual business? Well, basically, if the company does well, you do well. If the company keeps delivering consistent profits, makes good decisions, and generates more and more money each year, you will benefit not only by collecting easy money in the form of dividend payments all year long, but in addition, the stock price goes up. So your initial investment goes up in value on top of all the dividend payments you're getting. Another advantage is that good companies like Bell Canada, for example, or other profitable and reliable companies tend to increase their annual dividend rate over time. So this is where the power of the buy and hold strategy pays off. So let's go back to Bell Canada as an example so I could show you what I'm talking about. Alright guys, so let's go back to Bell Canada as an example. So right now the dividend rate is $3.33 and the dividend yield, if you would buy it today, would translate to 5.38%. This is annually. But let's go back and check out the dividend payments for the last 5 years. So here you have it. So this is the latest one to 2020. Like we just saw, it's $3.33. But if we go back 5 years ago to 2015, for example, the annual dividend rate is less. It's $2.60. This is a good thing because this means that this company is consistently increasing their dividend rate over time. So let's calculate it. So 5 years ago, the stock price of Bell Canada was about $53. So if we take the dividend rate of what it was then, $2.60, divided by 53 times 100 will give us the annual yield. It's 4.90%. Still pretty good, but not as good as it is now. So let's say we would never have sold those shares, and as passive income investors, we do just that. We do not sell anything. Right now, what would our annual dividend rate be? Well, basically it's $3.33. So if we take $3.33 divided by the share price of $53, that's back in 2015 when we bought it, times 100, the annual dividend yield or percent, as you can see, is much higher. It's 6.28%. So 5 years ago, we were making 4.90% a year on our money in dividends only, and now we would be making 6.28% a year on our money. So we're actually making more money than 5 years ago. This is, you could think of it as compound interest, and this is where the buy and hold strategy pays off, especially for these types of companies which tend to increase their annual rate over time. This is just 5 years, but in 10 years from now, it might be 7%. In 20 years, it might be 8 or 9%. So imagine investing, having shares of a company that gives you 8, 9, or even 10% or more in interest every year. That's just phenomenal. So what are the disadvantages of buying shares in an individual business? Well, if the company does bad, the stock price tends to go down. Don't forget, this is completely normal. All businesses have their good and tougher times. But remember, because we are not selling our shares, we don't care that much. This is where, again, the buy and hold strategy gives us peace of mind. Our concern is not really the stock price, it's the dividend. So as long as the company keeps paying out a dividend, we're still making money and we're still happy. So you might be asking, can a company that's not doing well reduce or completely eliminate its dividend? Well, the answer is yes. However, it's actually pretty rare and completely depends on the business itself and the circumstances surrounding the business, which are sometimes out of its control. Remember, the goal of dividend paying companies is to preserve the dividend. So if they reduce it, it's always for the long-term success of the company. Either way, dividend reductions are rare and really depends on the business you invest in and how risky it is. Many companies have never reduced their dividends in their entire existence. So the second type of dividend paying stock I want to discuss are real estate investment trusts, or REITs. So a REIT is a company that owns, operates, or finances income producing properties. So by investing in them, you're literally buying a piece of real estate. And we're not just talking about residential real estate like an apartment building. That's just one type of REIT. REITs can also be retail properties like stores and strip malls. They could be industrial real estate, office real estate, hotels, car dealerships, healthcare facilities, and more. So for those of you who want to invest in real estate, it's by far, in my opinion, the best and easiest hands-off way to own property. Why would you buy an apartment building? You'll have to deal with bad tenants, late rents, leaky roofs or toilets, foundation issues, maintenance costs, plumbers, electricians, insurance agents, real estate brokers, etc. It's a nightmare. So REITs are an amazing alternative if you're like me and don't want to deal with all that stress. About 20% of my personal stock portfolio is real estate, and let me tell you, it's the safest and reliable income you'll ever get because property values tend to be very stable and just go up in the long run. So REITs were created in 1960 by the US Congress to allow regular people like me and you to become property owners. God bless America, seriously. And I haven't even got to the best part yet. By law, REITs are obliged to pay out 90% of their income to their shareholders in the form of dividends. So that's very nice. It's hard to imagine any disadvantages, but there is one to mention. The dividends are not considered eligible dividends, which simply means there's no added tax break on the income during tax season, so it counts basically as regular income. So let's take a look at two REITs, both of which I currently own, so I could show you two examples. Alright guys, so let's check out two examples here. The first one is Northwest Healthcare Properties REIT. So as you could guess by the name of the REIT, they specialize in healthcare properties. Let's check out the dividend information. So their annual dividend rate is 80 cents a share, which translates to a dividend yield of 6.42% annually. That's a pretty good yield. Let's check out the last 5 years of dividends. So these guys give a dividend every month, which is good. So as you can see here in 2016, it was 80 cents. And if we scroll down all the way to 2020, it's still 80 cents. So very, very consistent income. Let's go on the company's website just for fun. So every REIT will have their own website, and this is where you can read up on some additional information on their properties and where they're located. So if we read through this one, they have 149 income producing properties, 10.1 million square feet in Canada, Brazil, Germany, Australia, New Zealand, blah blah blah, some more information. And usually we're also able to actually see the entire portfolio. So if we just for fun click on portfolio and click on Canada, you'll have all the information on their properties in Canada. If we would click on Germany, you would have all their properties in Germany. So pretty cool to see what basically you're owning once you buy this REIT. So let's go on to another example. Let's take Plaza Retail REIT, stock symbol PLZ.UN, and of course let's always go first to the dividend information. So this company gives an annual dividend of 28 cents per share, which translates to a dividend rate or interest rate of 6.25% per year. Also pretty good. Let's check out the last 5 years of dividends. So these guys also give out a monthly payout. And if we go in ascending order, in 2016, you could see that the annual dividend was 26 cents and not 28 cents. Which is good because it shows that this company is consistently raising their dividends. So you can see here 26. If we go to 2017, they boosted it to 27 cents a share, and in 2018 they boosted it to 28 cents a share, and it's been 28 cents sorry, since then. So if we go on their website and just go to about, you could read up on basically the information of the company. They have retail real estate. Total assets are over $1 billion. If we go to, if you want to check out some of their properties, why not? We just go to properties and leasing on their website, and here are some of their clients. So big name brands, KFC, Dollarama, Canadian Tire, etc. And if we actually scroll down, we can actually see exactly where all their properties are on the map, and they're pretty much all over Canada. So there you have it, guys. That's just two examples of two REITs that I own. The third type of dividend paying stock I want to talk about are ETFs, which stand for Exchange Traded Fund. So like the name says, they are a fund, where its shares are traded every day like a regular stock on an exchange, which is the stock market. So if you compare them to mutual funds, they both have a bunch of companies or securities in them, which reduces your risk, as we're not all throwing our eggs in one basket, so to speak. So what are the differences? Well, mutual funds, which are managed by banks and investment firms privately, so they're not listed on the stock market. ETFs are also managed by financial institutions, but they're traded on the stock market daily like a regular stock. So they're much more accessible and easier to buy. The other big difference, and this is the most important and main reason why ETFs are getting so popular nowadays, is because they have much lower management fees associated to them. So the ones I own, for example, vary from 0.55 to 0.75% a year, and many others are even lower. So compare that to a mutual fund, which is typically between 2 and 2.5%. It might not seem like much, but keep in mind this is an annual fee. So let's say you make 7% in a given year. That's pretty good. Well, after a 2.5% fee, it's only 4.5%. With an ETF, it would be about 6.35% or more. That's a lot less money lost to management fees and more in your pocket. So that's a big advantage. Another reason why I like ETFs is because we can easily invest in a very specific sector of the market or type of dividend stock. For example, as a passive investor, we only want dividend paying stocks, right? Well, there's plenty of ETFs out there that only have dividend paying companies in them and nothing else. That's just one example. Another cool thing about ETFs is that they could hold a bunch of non-dividend paying stocks like technology stocks or the new and exciting cannabis sector, for example, and give a good dividend. So how do they do that if the stocks don't give a dividend? Well, there's professional managers handling the ETF, and like a mutual fund, the ETF makes money not only with the dividends from the companies it holds, but also with other strategies that the management team can use. It all depends on how the fund is managed. So one thing to note about ETF distribution payouts is that the dollar amount can vary from payment to payment. So when a particular fund does well, the payouts are typically higher, and vice versa when the fund is underperforming. For example, ETFs that hold primarily energy stocks or gold stocks, so these funds will fluctuate with oil and gas and gold prices. So when gold or oil prices are higher and on the uptrend, the distribution payouts or the dividend payouts will be higher and vice versa. This can vary greatly from fund to fund and really depends on the fund's manager. So what does that mean for us in practical terms? Well, it's simply a bit harder to track the income you make from ETFs as it could fluctuate. Some more than others, but it's definitely not a showstopper. For ETFs, when you do your research and see the dividend yield, remember that's kind of like the interest rate you get if you invest at that time. You need to keep in mind that the percentage you're seeing is the average for the last 12 months. So at a quick glance, this is a very good indicator of the yield, but not the full picture because you're only getting 1 year of data. So luckily you can get the full picture by analyzing the entire history of the dividend. Don't forget that these are public funds, so the entire history of the dividend is always public knowledge and is very easily accessible either on the fund's website or in your brokerage tool. So let's take a look at two ETF examples, both of which I own, so we could piece all this information together. Alright guys, the first ETF example I want to look at with you, let's look at the BMO Canadian High Dividend Covered Call ETF. So the stock symbol is ZWC. So we could get a lot already from the name. So BMO is the, in this case, the bank that's managing this ETF. So it's the fund's manager. Canadian High Dividend. So we're going to expect a lot of Canadian dividend paying stocks in the fund. And covered call. So what covered call is basically a very common, simple and safe strategy that ETF managers use to boost the income you get from the ETF on top of the dividends from the dividend companies inside the fund. So I'm not going to go into detail too much of the covered call strategy, but I'll put some details in the description of the video. So if we continue on, let's check out the dividend information of this ETF. So the dividend per share is $1.32 Canadian. and the dividend yield is 7.40% a year, which is fantastic. If we go on BMO's website and check out more information about this ETF, we could click on holdings and we'll get all the companies that make part of this fund and the percentage of how much they make up the fund. So Enbridge, for example, which is the biggest energy company in Canada, makes up 4.95% of the fund. Now let's check out the dividend history, which is very important. So we click on distributions and we find out what it is. So this fund was created in 2017. That's why we could only go back as far as 2017. And as you could see from the 2017 payouts, there's 12 of them. That's because this ETF gives the dividends out monthly. So 2017, the total was $1.12. If we go to 2018, it's $1.23. If we go to 2019, it's $1.31. So these are very good signs because, as you could see, they are increasing the dividend throughout the years. So the second example I want to check out is called CI First Asset Tech Giants Covered Call ETF. So the stock symbol is TXF. So this ETF is managed by CI First Asset. It's a financial manager. And just like the name says, it will have tech giants, so a lot of big technology companies. Also, they also use a covered call strategy to boost the income you get from the ETF. And if we go down to the dividend information, the dividend per share is $1.22 and the annual yield is 7.35%. Another really good yield that you're getting per year. If we go on the website of this ETF, so on CI First Assets website, we could see all the information, including if we click on holdings, what kind of companies they have in this fund. So a lot of the companies you'll recognize. These are obviously technology giants. You got Amazon, you got AMD, Microsoft is there, Alphabet, which is Google, Apple, Intel, etc., etc. Oh, Facebook is there too. And if we go, let's check out the dividends now. If we go to the distributions, we could see that we have information all the way going back to 2011, which is when this fund was created. So if we look at the annual dividend rate here, it's only 18 cents. Why is it only 18 cents? Well, because there's only one payment, and this fund gives a dividend quarterly. So you have 4 dividend payments a year, opposed to monthly where you get one every month. So 2011 is not really a good indication because they only paid it out one payment. So if you go starting in 2012, this is where they actually gave out 4, which is the full year. So that's when we could start realizing what kind of dividend it has. So 2012 it was 0.90, and as you could see throughout the years, it fluctuates a little bit. But in 2018 and 2019, you could see a big jump. It went from 80 cents in 2017 to $1.32 in 2018 and $1.21 in 2019. This makes perfect sense because in the last couple of years, technology stocks have exploded. So this is a perfect example when I said before that ETF payments can fluctuate. So it's not necessarily a bad thing. It could be a good thing if the stocks you have in the ETF are on the uptrend, like technology stocks are right now. Okay, so the last type of dividend stock I want to cover is technically called a closed-ended fund or investment trust, but normally it's referred to as an income fund. Let's not get too hung up on the terminology. Personally, I refer to them as simply an income fund. Let's compare them to REITs and ETFs as they share a lot of the same similarities. So like ETFs, there are several companies in the fund. The amount can vary, and they usually have a lot of dividend-paying stocks. In addition, they are both listed on the stock market and traded every day. Now if we compare them to REITs. First off, they are both technically an investment trust. Don't forget, REIT stands for Real Estate Investment Trust. Second, they both have a .UN after the stock symbol because you're buying a unit of a fund and not a share of a company. Small difference. Third, they have a very consistent dividend payout, and I'm talking about dollar amounts here. So it's very easy to track the income. And fourth, the best for last, is most of them have monthly dividend payouts. So consistent money every month. Who's not a fan of that? So once again, it's example time. Let's take a look at two income funds so you could see for yourself. Alright guys, the first income fund I want to check out with you is called the Canoe EIT Income Fund. So the stock symbol is EIT.UN. Don't notice the .UN just like real estate investment trusts. That's because income funds are also considered investment trusts. They're basically buying up a unit of the fund, hence the UN. So if we look at the dividend information, the annual dividend rate is $1.20, which translates to a dividend yield of 11.79%. That's really high and really fantastic. When in doubt, always look at the dividend history if you're skeptical. That's what I do. So let's look at the dividend for the last 5 years. If we put it in ascending order, you could see in 2016 the annual dividend rate was also $1.20, and all the way until now it hasn't changed. It's always been $1.20. So very consistent payouts, which is fantastic. If we go on their website, so you can see here it's managed by Canoe Financial. You even have a picture of the guy managing it, and you get basically all the information you need about the fund, including which companies are in the fund. So here are the top 25 companies. A lot of them you'll notice, the pretty good companies: Home Depot, Wells Fargo, Coca-Cola, Microsoft, etc. You could also get a sector breakdown. So how many of the companies are financial, how many are energy, and also the geography and the asset mix. So you could find out how many are Canadian companies, US companies, etc. So the second one I want to talk about is called the European Focused Dividend Fund. The stock ticker is EF.UN. So this obviously will have a lot of European focused dividend companies in it, like the name says. So the dividend rate is 60 cents per share, which translates to an interest rate of 7.61% a year. So if you look at the history for this one, and this one is a fairly new fund, so they don't have many payouts yet, which is normal. Yeah, so it started here in 2018. So in 2018, it was also 60 cents, which is the same thing it is now. So 2018 all the way until now, 2020, you could see that it's remained the same. So this is where I was talking about when I compared them to REITs, where the payouts are very consistent and constant, unlike ETFs where they could vary a bit. So if we go on the website of this fund, so this fund is managed by Middlefield Funds, and you can see all the information you need. I usually always look for the fact sheet. That's where they have like a little sheet where there's a condensed information of the fund. So you have all the information you need to know. Here's some of the companies, so the top 10 companies, and you'll see a lot of them are European. The geographic allocation, so in this case 52% of the companies are non-Canada, non-US, which makes total sense because we expect them to be a lot more European companies. And you'll also get the management fee. So as you can see here, the management fee is 1.1%. And there you have it, guys. So now you know the basics of each type of dividend stock. Please note that there's no way I covered everything about these stocks because it's just a beginner's guide and I don't want to make a 30-minute video and bore you to death. I'll add some links in the description of the video so you could read up more yourself. Don't forget, knowledge is power, and that equals to more money. So in the next video, I'll be discussing on how to open your own brokerage account and give you a quick tour of the one I use so you can see how simple it is. So thanks for watching, guys. Please hit the like and subscribe button if you haven't already done so. If you have any questions, please put them in the comment section below, and see you next time.